This is going to be everyone's favorite lesson. Order blocks. One that you lot keep asking for, the one that I said is coming in chapter 2 is coming in chapter 2. The ones that the people with no prior knowledge, they keep asking me, what's an order block? You keep saying order block in your weekly commentaries. I don't know what that is. This is going to be about order blocks. This video doesn't have to be long. I'm not going to drag it out for no reason. Short and sweet. Order blocks. So this is another reference point to price, yeah, in the algorithm. Chapter 2 is just going over all the reference points to price, where price could see rejections and where we expect price to, go from bullish to bearish and bearish to bullish. Yeah. So a bullish order block is the lowest down close candle before bullish displacement. And now the keyword is displacement. Yeah. Bearish order block, the highest up close candle before bearish displacement. Now, what do I mean by displacement? I'll tell you exactly what I mean by that. Displacement. When we're talking about displacement, we mean a move away from the candle. So this is an example, right? On the 5 minute, this is an example of a bullish order block. Last lowest down close candle before the bullish displacement. Another definition the guys might hear is the last down close candle before the big up move. It's just reworded. It's the same thing. Whatever one you like, you can either use my one, which is I prefer it, bullish order block, the lowest down close candle before bullish displacement, or the last down close candle. So this is the last one before we move up higher, right? The last down close candle before the move up. Yeah. So look at the movement away from this candle. This is what's gonna separate order block from the shit that you hear online. Look at the movement away from the order block. It is double the size of the order block initially. Yeah, essentially, I mean. If you had, I like to call it skinny movement because like weak movement, yeah? No offense if you're a skinny guy, I'm skinny myself. We're weak together. If you have a weak movement away from it, it doesn't show a willingness to go higher. That's what we want. We want to see the willingness to go higher away from the order block. So if this candle was, small candles, just barely breaking above it, it doesn't show a willingness to go higher. We want to see down close candle, up close candle straight away in a bullish narrative framework. Yeah, because the Euro USD was a bullish narrative today, right? So for example, this is a breaker block. Yeah, and you're going to see how all of these work together now in tangent together. Yeah, this is a breaker block. We trade a bit into the breaker block, a bit below it. I think if you go on a 15-minute or 1 hour, this candle is multiple candles together. And then we send it higher. Now, what's this candle? This candle is the last down close candle before bullish displacement. So that is the criteria for an order block. So we drag this one out and we see the retracement into the order block. And what's created again at this order block? Another order block. Do you see where these things form? They form at our support and resistance levels, not the retail ones, not the retail ones. They form at our support, our institutional support and resistance ideas, where we expect this bullish breaker, yeah, this bullish breaker. If you guys are wondering, why is it a bullish breaker? Low, high, lower low, higher highs. So this is the last up close candle in the high between the lows. You'd want to delineate out in time. That's your bullish breaker. What do we expect to happen at bullish breakers? We expect price to respect it. Respecting means reject, and rejection you can say is support. Again, an order block forms there. Now, at the order block, when we go back into it, what can we expect? We can expect support to be found. So this is where you look for the order blocks. You look for them at key levels. Yeah. When you're at your significant level, you use these as entry models on the lower time frame. So when you come back into here, you know now you could be hunting an entry. Within this down close candle, you can be hunting an entry. Yeah, you'll be hunting an entry, and then you'll see this candle, upwards candle, and this high takes out this high. Your market structure shift, right? Comes back into the order block. Your stop loss, you want to put below the order block. Or if you have a little low like this, just below the order block, just put it below the low. It's like another 1 pip difference. Yeah. Now, algorithmically, why is it important? Because you know I always give you guys the theory because I want you guys to understand. Because with the greater understanding, you can apply it better. It's a reference point in time, and that's what we said. Everything in this chapter is a reference point in time, but a reference point in time to the algorithm showing what? It's a reference point in time to the algorithm showing a change in the state of price delivery. Hence why I like to use the word displacement. Displacement means movement from your origin. Yeah? How far you're moving away from your origin. The origin being what? The origin being the change of the state of delivery. Now, for the people that do A-level mathematics, if you're doing mechanics, this is where your S is equal to 0. And you know S equals to 0 is very significant because with S equals 0, from a mathematical standpoint, a mechanical standpoint, you can have a lot of fun with those type of equations. And it's the same thing in this market, right? So you want to go back to the origin of the displacement. And when was the origin of this displacement? At the open of this candle, because the displacement is everything after this down close candle. Yeah, so it doesn't start from here. It's above the candle. When you move away from it significantly, that's the displacement you're looking for. Now the reference point we're looking to enter, or we expect a reaction, is the opening, because remember, algorithmic computation 101. I'm just going to call that algorithmic computation 101 now, because I always bang on about it. And you guys, it should be drilled into your head by now. The guys that are up to date and watching every video as they get released. A simple algorithmic computation is at the open and the 50 because they are simply easy to code. They are simple algorithmic computations. If you're going to code anything to do with this market, you're going to want to put 2 reference points in price. Yeah, because you don't want just 1 reference point in price. Remember, if you only have 1 reference point and everyone sees that, oh, when is a down close candle and a significant move away from it, we keep coming to the open of the candle and moving away. You want to throw people off. You want to change it up. So you say reject off open between open to 50%, because now that gives you like a ballpark to play with. So you got the open to the 50%. Now it can keep coming in between that and it'll throw people off because they don't know where it's going. Retail won't see it. But us, because we're exposed to it, we understand it and we know that what we can expect from the order block. Yeah? Now, algorithmically, it would want to go back to the initial of the displacement. What does it leave behind? A fair value gap. The order blocks with the imbalance left behind are the ones you want to take. We're going to touch imbalance next video, but essentially, before this candle, let's do a replay figure. Yeah, yeah, cool. Down close, up close candle. Now, what's left here? What is left here? From here to the open, there's only buying going on. This is your imbalance. Yeah, from this candle's high to this candle's close, there's only buying within this candle's here. Yeah, So that's an imbalance. Now you have your order block and the imbalance. Algorithmically, that is like screaming, come and fill me, come and fill me. Do you know what I'm saying? Down close. Now, when this candle happens, the imbalance then shortens. Yeah? Because now sell side has been delivered here a little bit. The imbalance reduces now to the area between this wick and the high of this candle. What happens? We go and we tag in the open of the order block, and the rest is just, movement away from it. Now you have your new order block here. It decided to just fill the imbalance instead, move away from it, and now we just have this. Yeah, it's not a hard lesson. It's a pretty simple lesson. Now, one thing I want to go over with you guys is this is also an order block. But Omar, you have two candles. It's meant to be the highest up close candle. It should just be this one. If you go into a time frame, right? Because the market is a fractal, these two candles together, right? These two candles together on, for example, a 10-minute time frame, there will be one candle. So when you see multiple up close candles before the significant down move, if they are consecutive, and by consecutive, if you don't know what it means, consecutive means one after the other. If there was a bullish candle and then a bearish candle, like in between there was one bearish candle that disrupted the consecutiveness of these candles, then you will take the last one. But if they are consecutive and nothing is disrupting them, and they're just one after the other, so let's say there was two of them, there could even be three of them. If this candle was also bullish, and there was three bullish candles before the down move, you will have your order block. Or these two candles together make one order block because this is the buying. This is the initial before the displacement happens. Yeah, this, and what happens? Tag it and move down. Now, what would you also see in here? Just fast forward into the future for when we go over it, because you also see what here? The mitigation block. This down close candle. This down close candle right here is your mitigation block. Mitigation block and order block. For your own backtesting, tell me if you can find mitigation block without the order block. Tell me if they're not always found together. Yeah? Wherever there's a mitigation block, tell me if there's no order block. Yeah? That's just your own little study. And it'll be interesting. And it will start making you think. Because there's a reason why whenever there's a mitigation block, there is an order block. All the time. Whenever there's mitigation block, there is order block. All the time. It's not the other way around. Whenever there's order block, there's mitigation block. But whenever there's mitigation block, there is order block. Yeah? And there's reasons why. And when we go over it, if someone does get it right, I'll tell you the theory why, whenever there's mitigation, there is order block. And when you understand the theory why, it will click. It will start to click for you guys. Now, if this was a down close candle, let's go this one. Let's go into a 3-minute. Okay, still one candle. Let's go into a one. Still one big candle. 10. Okay, so like here on the 10-minute, if you're watching the 10-minute, you would want to put the box here. Yeah, you would want to go here on the 10-minute. Now, on the 10-minute as well, you would want to bring this down to this candle because these are the last two up close candles on the 10-minute before the down move, and on the 10-minute, these are the last two down close candles before significant displacement. Yeah. So you see how when you change the time frame, the number of candles change as well. Now, if you want to refine it, you can go down your time frame and you can refine it to just this candle. You can do that, but it's just safer to take, for example, if you're looking at the 15, if you're looking at the 15, right? This is all one consecutive order block. All of this is one consecutive order block. Yeah, one, two, three, four. It's all one consecutive order block. But how big would the stop loss be if you're here and you put a stop loss in? Like, don't get me wrong, you'll win the trade. You would win the trade, but your take profit will need to be like up here for 1 to 1. So if you just highlight this whole area and then you dive down deeper and then you can refine it, you start looking within those 15-minute down close candles, you start to see that it's this sideways wedge type pattern. And then you can actually pinpoint the change in the state of delivery. The change in the state of delivery was here, this down close candle before the up move. So how would you enter off of it? If you want to use it as on the lower time frames as an entry technique, when you see this, you put you entry there at the open. Your stop loss goes behind your stop loss goes below the low, and you don't want to be overzealous with the high. I mean the take profit. You see like this high, right? You see how we took out this high before we retrace into the order block. Just aim for the next high. Because you know that this high has gotten taken out. The high next to it is likely to be taken out because of this market structure shift. Higher, lower, higher. Yeah? This is your breaker block for anyone interested. There's probably two candles here. Because of this candle, it's got like a wick on it. If you highlight this candle, I'm pretty sure there will be two candles within this one. Because there's a rejection within the wick of it. You don't want to just target. I see people they just don't even, their target isn't placed on the market structure. They look at this number when they're looking for a take profit. When you're trying to do a take profit, this number is not what you're looking at. What you're looking at is, where am I targeting? Where is price targeting? You're not caring about the number. Don't attach yourself to the number. Put your take profit above where you know price is going to deliver, because yeah, it ran into here. You could have put your take profit here. But if you don't have a take profit and you're trying to close your take profit manually, your human nature, just because of the natural greed, etc., you're not going to close it here. You won't be satisfied. That's why you place the take profit and you never change the take profit. When you enter the trade and you place your stop loss and your take profit, those don't change. They don't change unless your analysis is wrong. Then you remove the order entirely. But once you're confident with the trade, your stop loss and take profit, they don't move. Because when you put your take profit there, you told yourself initially you're happy with that. You're happy with that level of profit. You're not trying to push it and become greedy. You don't want to reach for this high. The way you would want to do it is aim for this high, right? And at this high, if you're monitoring it and you're at your setup, when it's coming up to it, you can take off something like 80% of the position. You can close as a partial, and then you can let 20% run. See if you have the willingness to run all the way to the high, and then you can close the entire trade. Because if you want to let the whole trade run here, look at this. You would feel squeezed when it's coming down. You will feel like a retail squeeze, yeah? And you might close your profits down here, although it goes back up. But what about if it went all the way back to stop loss? Because remember, we ran these highs. We ran all of these highs, yeah, into an order block. Because remember, it's about the willingness. It's about the willingness to run the high, yeah? If there's order block there and there's mitigation block there, this is what we call adding resistance to running the high. If there is these order blocks and mitigation blocks and gaps, those are all potential reversal points for price that I've taught you. So running the high, well, as you get to the top of a high, you'll see there's always order block and mitigation block. It increases the resistance of running the high because the algorithm will recognize these reference points to price and reject off of it before coming up higher. Therefore, you don't always want to maximize your profit. You always want to take your take profit should be in areas where without a doubt it's getting hit. Like it's a no-brainer, it's getting tagged. Yeah? And the stop loss should be somewhere where the algorithm has no, you know, willingness to deliver to. It's already been delivered to. For example, if this is a true order block, this displacement, true order block, algorithmically, why would we want to trade through it? Yeah. In the context of a higher time frame bias for the euro, a bullish day, why would you want to trade? Why would you want to trade through the order block? You're respecting bullishness, right? You're taking out highs and you're respecting lows. So therefore, this low, once we establish some sort of support within this order block, this low shouldn't be taken out, right? So your stop loss should go below it. And if your stop loss gets hit, well, that's fine. You're offside. Don't try rush to get into the next trade. Just chill out. The next trade will come. Take your opportunities as they come. Yeah? So now, that's on your lower time frames. Just remove all these drawings. If we consider the higher time frames, so let's say, for example, the daily, the order block, and I don't know if you've realized how I'm teaching you guys, like higher time frames and low time frames, all these breaker blocks, mitigation blocks, order blocks, they all exist. However, the order blocks, so like for example, this candle, on the higher time frames, they're not entry techniques because there's no way you're entering on a daily. Yeah, can you imagine entering on a daily? Look, stop losses 82 pips. Yeah, no one's doing that. This is where you want to expect a reaction. So when price trades into there, you're not trading. When price is in that area, you're seeing how price is trading within it. Yeah. So always have your higher time frame breaker, mitigation, order block, and we're gonna go through the rest of them. And soon you're gonna have all of them outlined, and you're gonna see how price is reacting in each one. Yeah. And this is where you will look to see the willingness to go lower, or if price is willingly trading through it. And that's key. This is going to provide structure to the market because this is the true market structure. You'll see the market structure, all the highs and the lows, and the highs and the lows, they happen where? They happen in some sort of institutional reference point. So in here, yeah, we have this gap. We overshoot the gap a little bit. We make a high within the gap and we come down lower. Then we make this high and we come lower. The high is in the form of what? This is a mitigation block, order block, and we're coming down. So it's normal. If we see reaction off here, then we'll create a daily high. Again, coming lower. This up close candle, also look, mitigation block. This down close candle is the mitigation block. This up close candle is the order block. You see how they're together? Now, you see how we come here, this displacement, and then boom, you sink underneath it. That's what you're looking for. Now, if we start to, this is the daily. If we have retracement back up, like we see here, there's retracement back up. You look for the logical point the retracement is going towards, the order block. Every retracement is calculated. It's not by chance. It's not by a miracle. It's retracing into the order block. Why? It's going back to the initial displacement of the change in the state of delivery. Literally, that's all it's doing. Now, we go into the order block. Now here, 28th of October. Let's go on an hourly chart, 28th. December, November. So what happened? Look at all these highs here. All of these relatively equal highs. 1, 2, 3. We shoot above it. Like, we shoot above it. All these buyers, they're tapped into the market. Yeah, they're tapped in so quickly. Look how quick. There's barely any time to react if you're thinking. And if you're buying up here, you're not taking profit. You're waiting to go to the moon. Yeah, all these stop losses are smashed, and then what happens? They sink it immediately. They sink it. Yeah, taking out these highs, and then what happens? You break the low. When you break this low, like here, like this significant displacement. Look at the intent with the candle. Look at the way you break through lows and highs. It shows everything. Significant move down. It's literally just a bodied candle. Then what? Retracement up into it. This is an order block. The last up close candle before the move down. And you move down higher or lower. All the way you're taking out all these people that got in with the move. Short lived. All of them destroyed. Yeah. Retracement back into this fair value gap, come down lower, and then it's just pure bearishness. But that's the lesson on order blocks. The last down close candle before significant displacement upwards is the bullish order block, and the last up close candle before significant bearish displacement is the bearish order block. So, for example, these two collectively, let's go on a 4 hour. Nah, it's not that nice. Like this one. Your imbalance area here. I don't know why that's fat. Let me just change that. So why isn't it 3x? Bit weird. So if price has a willingness to go down lower, you know what it's reaching for. There's this imbalance from here to here, and this imbalance from here to here. Then you have the order block, and then you have the low, right? You're seeing where price wants to react off of. And this is where patience pays. This is where patience pays. Because it doesn't have to get to the order block. It could just fill this imbalance. Because remember, if you look at the premium and discount, all of this, all of this imbalance and the order block is all discount. It's all below the 50. So this is where logic and framework comes in. This is where time and price comes in. If it's, a certain time of the day and you're here, it's likely that, okay, then we probably aren't going to trade to here because of the time factor. That should be a light bulb moment for you guys. You gotta match these price areas with the timing of the day that you're at. If you're trading within the time, let's say London session here, at the mid-London session, you're just, you're chilling within here, you're going sideways. Well, what's likely? You're likely not going to trade lower here because you're just respecting this, right? And then you might move up higher. This is where the time factor aids the price factor. Time and price. You want to see what time are these getting traded into? Yeah. You don't want to if these are getting tagged at like 5 p.m. You don't want to trade that. If they're getting tagged at like, you know, like I don't know, maybe at 5 a.m. in the morning, you don't want to trade that either. Remember, we're gonna get into the time aspect soon, but that should go in your notes automatically. It's about blending the time that you get traded into these areas. Now, the order block, yeah, let's not strive away from the order block. This is the order block. The last down close candle before significant displacement upwards. Yeah. And you see again here, this is the order block as well. The last down close candles before the significant move up. Now, why not this one? Why not this one? Look at the disruption between them and look at how small they are. They're not significant. They're small and they're in between. They're just disrupting this bullish move up. These are clear, beefy down close candles. Down close candles, two of them together will make the one order block. If there was four of them will make the one order block, etc., etc. Price comes into it, shoots up higher. That's an order block. Yeah, there's nothing else to it. There's nothing more than that. Now, you want to obviously use the order blocks that are in line with your bias. If you're bullish, don't take bearish order blocks. They Everything has to be in line with your bias. It all has to blend together with your bias. If you're bullish, do not trade bearish signatures. Do not trade bearish mitigation blocks. Do not trade bearish breakers. If your bias is truly bullish and it's truly a bullish day, they will not work. They will collapse. They will get traded through, disrespected. You want to see bullish order blocks, and this is going to add to institutional order flow. As you're seeing order blocks, if you're seeing down close bullish order blocks being respected, you're seeing bullish breakers being respected, bullish fair value gaps being respected, that's called institutional order flow, and that's a whole different game. That's a whole different game to market structure. And when I help you guys unlock institutional order flow, you will realize how much it trumps market structure. Market structure doesn't always work. You see highs and lows get respected all the time. This high, this low. Yeah? Oh, market structure shift. What's the institutional order flow? That's what you don't hear because people don't understand institutional order flow and they don't understand algorithmic order flow. But those are going to be later lessons. For now, this is just order block. Plain and simple. Nothing hard about it. Activity for you guys. Just highlight order blocks. How I do it. Using the definition of what I had. I think it's gone now because I removed the drawings, but you lot should have it in your notes. The bullish order block is the lowest down close candle before bullish displacement, and the bearish order block is the last up close candle before bearish displacement. Now, using that and using the examples I've shown you guys, I want you guys to show me an order block where it's just a single candle and an order block where there's multiple candles. Yeah, play around with it. Look for different examples because you want to be dynamic. You want to have more than just, this one. You want to have a few, like you want to be able to identify the order block through the definition, not through the visual, what it looks like, but through the actual definition. Because essentially, it's where all the selling happens, right? Does the selling start from here? No, the selling start in this price range from here to here. The selling starts from here. Yeah, the selling starts from this candle's open here, and it goes down here. It's not. It doesn't start from this candle. The selling starts from here. They're consecutive. They're next to each other. Hence why you take both of them. This one, well, the one next to it, there's it's not down close candle, so we just take this singular one, extend that out in time, and those are your reference points to price, and you want to see reactions off there. Or if you manage to get short, well, you know where you can expect reversals to happen within these gaps. So you get short and you want to exit at these areas. It's not hard. Yeah. Anyway, that's this lesson, order block. I'm going to consider doing 2 videos a week for this chapter because there's going to be a lot to get through, and I get nothing out of longing out the mental shit for you guys. I want you guys to get funded. I want you guys to, just prosper basically. So I'm gonna get this video out for you guys. Well, I'm gonna render this one now, and then I'm gonna try and make another one. Not today, maybe tomorrow or Friday. Um, but yeah, any questions? You know where to find me. Snapchat, the Discord question section. Avoid private message me on Discord because I, I can't find the message. It's like I have so many that it's just hard for me to get through. Yeah, talking about Discord messages, I just get one. How ironic. Yeah, Snapchat or the Telegram. If you're not in the Telegram chat already, join it. The one for the mentorship is more active. I think people like to use Telegram over the Discord. But yeah, don't forget the activity. Do the activity. Do the homework. The homework will get you where you want to be. There's no cutting corners. There's no cutting corners. It's all hard work. You cannot cut corners. Don't think you can watch the video without taking notes, without applying it after taking notes, and think that you will have success. No, you won't. You won't. Trust me, you won't. You need to actively be participating. It's fine if you get it wrong. It's fine if you get it wrong. Anyway, that's all for this one. Questions, ask me. Other than that, I hope you guys stay safe.